Welcome to another video whereby I'll be teaching you or showing you one of the confluences that I use and before I take any trades, right? So this will be a rather more informational video for you. Most of you know what this is and know how to use it, but then some of you probably are interested in learning how to use it, then this video is for you, right? So what we're going to talk about in this video is FVG, right? Fair value gaps. Now, what is a fair value gap? Simply a gap between three candlesticks, right? Where the market didn't move as it was supposed to do, meaning there's a gap, and then there's potential for others to get filled at that point, right? Meaning the market will return to that gap to fill the gap out, and then it will move out, right? So that's what a fair value gap is. Now, keep in mind that fair value gaps or a fair value gap is not a strategy, right? We don't take trades based off fair value gaps, right? It is a continuation confluence that we use. And again, it can be used as an early signal to show us that there is a shift in the market, right? A market structure shift from bullish to bearish or from bearish to bullish, right? So with that being said, anyway, let me minimize myself here a bit and show you what fair value gaps are. Okay, there we go. So I hope it won't be as laggy as on those other videos. If it becomes laggy, well, I'm sorry. I guess I'll have to upgrade my PC. Anyway, so a fair value gap, a gap between three candlesticks, right? So it's something like this. We have a candlestick, one, right? It has a wick and a wick there, right? And then we have another second candlestick, which is probably this long, very long. So we have another wick and a wick here, and then the third candlestick, let's say close somewhere, closed somewhere, oh, somewhere there. Then we have this wick here. Now the gap between three candlesticks, the gap, read my lips, the gap between three candlesticks is what we call a fair value gap, right? So we're looking for a gap as it says. My mouse is dying. Anyway, so the gap between these three is gonna be here, right? Where we have this wick up here, and then there's wick down here, right? So we have this gap here. The market didn't move as normal, right? Because if it did, then the wick was supposed to come all the way up here, or from this candlestick to down there, right? So what do we expect when there's such? What usually happens when there's a fair value gap is that price will move out, right? And then it will come to fill this gap here, right? And then it will move out, right? So it can fill the gap using a candlestick's body or a wick, right? And then once it moves out, we can now say the fair value gap was filled, right? So another thing that we should be mindful of is if, okay, let me save this one for later. For now, let me show you real chart examples of fair value gaps. Let me remove this. Okay, there we go. So real chart examples of fair value gaps. Let's start somewhere here. Let's see if we can find any. Okay, there we have one here. So between this candlestick here, the black candlestick, black, and then this one here and that one, right? So there's a gap in between those three. So we're gonna use a rectangle to highlight that. So from that wick to that wick, right? So you see there was a gap down here, And then what happened? Price came down with a wick to fill that gap in, then it moved out. Right? Exactly how I explained it using my drawings. Right? So let's look for another one which could for a downward movement, because I just showed you one for when price is moving up. So let's see there. So remember, this is for the purpose of explaining it, right? So don't come for me. So what do we have here? There, there. A fair value gap. What did price do? It came into the fair value gap, filled it, right? Then it went out. See? That's what a fair value gap is. And okay, I was still checking if we're not lagging or not. So let's see if we can find another one. There's another one here, but okay. See, there. What did price do? It went up, it came back into the fair value gap to fill it in, and then it went up, right? Now, some of the important things to keep in mind with fair value gaps is that it only becomes invalidated if we close below this rectangle's marking, right, with a full body, right? However, if we only have a wick, it comes down with a wick, then it moves out, then we can say the fair value gap was filled. However, if we close with a full body down here, let me use my brush. If we close with a full body down here, if price came down and closed here with a full body, then we would say the fair value gap has been inversed, right? And then that's another concept which we're gonna cover later on, right? So yes, when a fair value gap, when the market closes below or above a fair value gap with a full body, with a full candle closure, then you can say the fair value gap was invalidated. However, if we only have a wick, a proper retracement, we can say the fair value gap was filled and respected, right? So another thing that I wanted to speak about is when fair value gaps are stacked up on top of each other, right? For example, here we have more than one. In this case, we have, wait, let me get my, okay. We have one here, right? We have the second one there. Then we have the third one here. Right. So what happens when we have three fair value gaps, right? So the only time we can say these fair value gaps have been invalidated is when we have a full candle closure below the first one, if the market is moving upwards, right? So if we close below here, we get a candle closure down here, then all of them were invalidated, right? However, in terms of retracement, we can only, even if it comes down to the first one and moves out, all of these down here were filled, right? So again, if let's say we come down and we only fill two and move out, that means this one down here was filled as well, right? Which is what the market did here. Okay, so again, it can happen for the market to come all the way down here and fill all three fair value gaps and move out, right? That's also possible. So I just wanted to highlight that if it's again possible for the market to only fill one or two, then move up, right? Doesn't necessarily have to fill all of them, right? Now, does this mean when the market comes in here, let's say we have one fair value gap and it comes down to the fair value gap, we will then press buys and targeting previous draws of liquidity? No, that's not how it goes. This is why I said fair value gaps are not a strategy. They are just a continuation confluence, right? Which confirms that we are about to continue this bullish order flow or a bearish order flow, right? By filling those fair value gaps. That's what they are, right? So for some more examples, let me see if I can find more stacked up fair value gaps to the downside. Okay, so we have this one here. I'm not sure if this is a good example, but it's similar to the one that we had. We have one here, and then we have the second one. Okay, this is good. We have the second one here. Let me zoom in. See, 1, 2. Then we have the third one all the way down here. And what did the market do? So okay, let me remove this bar so that it can be clear. What did the market do? So we had 3 fair value gaps, right? In this case, they are not stacked up, but they are, I'm not sure what the right word is to use, but then 3 fair value gaps below, you see, as you can see on the chart. I'm not sure, I will find the word for this. I have to work on my vocab. Anyway, we have 3 fair value gaps in a bearish order flow, right? What does the market do? It comes and fills the first one and it moves out. What does that mean? These two, the first two, were also filled, right? Just because we didn't come here and there doesn't mean that these now uh, haven't been filled just because we only filled one, right? And then another thing is, you see we filled this one and then we moved out. Now all these 3 are filled, right? That means when if price decides to come up here, let's say we filled the fair value gaps and then we decide to come up here, it doesn't mean price is looking to fill these fair value gaps. That's not how it works. These were already filled and we are not looking at them anymore, right? So if price comes up here, then we will simply have a break of structure here to the upside, and we'll be changing order flow from bearish to bullish, or from a downtrend to an uptrend, right? So that's how fair value gaps work. And I see online some people confuse them and they see a fair value gap which is filled, and then once they see that the market is coming up, because we didn't reach these two, they think the market is filling these fair value gaps, which is incorrect, right? So based off of what I know and my market experience, that's how it goes, right? I'm not trying to say what other people are doing is incorrect, right? It is, but that's not what I'm trying to say here. I'm just trying to give you the right information which I use. Right. So those are fair value gaps, and that's how we read them, and that's how you can use them. Again, does this mean when price comes down here, we can now press sell, sell, sell and target these lows? No, we don't do any of that. We're simply looking for fair value gaps to be filled. We still have more confirmation confluence which have to be met before we can take trades, right? This is one of them, one of the confluences. So we don't rely solely on fair value gaps, you see. So with that being said, I believe this will be the first part of fair value gaps, and then I'll upload the second part because I don't want to put everything to one video. The video will be too long and it can be confusing. So yes, this is what fair value gaps are, and this is how you can read them. So with that being said, I'll see you on to the next video. Cheers.